Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And we begin today in North America. In a bold escalation of trade policy, yesterday, Monday, US President Donald Trump announced a 25% tariff on all imports from any country that purchases oil from Venezuela. The move, unveiled via a Truth Social post, adds another layer to Trump's assertive trade strategy and is expected to disrupt global crude markets. Trump justified the decision by alleging that Venezuela had sent, quote, tens of thousands of high-level and other criminals, end quote, to the United States, including violent offenders. His administration framed the tariff as a national security measure, though analysts argue it primarily serves as an economic sanction. Venezuela exported 660,000 barrels per day of crude in 2024, with China, India, Spain, and Italy among the top buyers. China has already been subjected to Trump's 20% tariff this year, and the new measure will further strain trade relations with Beijing and other key global partners. When pressed by reporters, Trump confirmed that the 25% duty would be applied on top of any existing tariffs. An executive order published Monday stated the tariff would remain in effect for at least 1 year after a country's last Venezuelan oil purchase, unless the U.S. Commerce Secretary authorizes an earlier removal. The U.S. itself imported 230,000 barrels per day from Venezuela in 2024, making the country its fourth largest crude supplier. The announcement caused crude prices to rise by 1.3% as traders anticipated further market disruptions. Matt Smith, lead oil analyst at Kepler, speaking to US-based The Wall Street Journal, observed today, quote, if we see Venezuelan supply coming out of the market, that means less global supply, which means oil prices go up. That gets passed on to prices at the pump. End quote. While some nations may attempt to navigate the new restrictions, analysts suggest that most will likely self-sanction to avoid the sweeping tariffs. Without clarifications or exemptions, most countries will simply halt Venezuelan imports to avoid the penalty. The US Treasury has also played a role in tightening economic restrictions on Venezuela. On Monday, it extended the deadline for Chevron to wind down its Venezuelan operations until May 27th, following its earlier decision to revoke the company's license. Chevron has exported roughly 200,000 barrels per day last year under a special exemption, a trade that opposition leaders claim helped fund President Maduro's government. This latest tariff move comes just days after Venezuela agreed to accept deported migrants from the US as part of a broader immigration deal with Washington. On Sunday, a US deportation flight carrying 199 people arrived in Caracas. Ryan Berg, director of the American program at the Center for Strategic and International Studies, noted that the tariffs could further isolate Maduro's government. Quote, if this measure extends to all businesses engaged with Venezuela's oil sector, it could push companies out and make it even harder for Maduro to maintain economic stability, end quote. He said to UK-based The Financial Times, adding, quote, we're in entirely uncharted territory. End quote. With new tariffs set to take effect on the 2nd of April, coined by Trump as Liberation Day, the global energy market now braces for yet another potential supply chain upheaval. As the world watches, both economic and political fallout seem inevitable. Next up, we continue our ongoing coverage of the deteriorating political and economic situation in Turkey. Turkey's financial markets have been rocked by political turmoil following the arrests of Istanbul's mayor, a key opposition figure, and President Erdogan's main political rival. In response, Turkish authorities have introduced sweeping measures to stabilize the country's stock market and currency, including a broad ban on short selling and relaxed buyback rules. The Capital Markets Board, CMB, extended its previous short-selling ban, which had applied only to the top 50 listed companies, to all publicly traded stocks. At the same time, listed companies can now repurchase shares above the last market close, while margins trading requirements were lowered to 20% from 35% to ease liquidity pressures. The move follows last week's sharp sell-off, which saw Turkish banking stocks plunge to their worst weekly decline since 2001. The economic fallout from the opposition figure arrest has sent the Turkish lira to historic lows, prompting the central bank to step in with an emergency rate hike. Despite these efforts, the lira continued its downward trajectory, trading at around 38 per dollar in Asian markets on Monday. Analysts warn that the political instability and rising country risk could further undermine investor confidence. Kyle Rodder, senior analyst at Capital.com, expressed this week, quote, "At the margins, moves by authorities could quell things or stop markets moving in a volatile way, but the underlying concerns remain for investors." End quote. He noted that higher risk premiums on Turkish assets would likely persist as uncertainty looms over the country's political and economic direction. In an effort to maintain liquidity and prevent excessive lira depreciation, Turkey's central bank held discussions with commercial leaders over the weekend. The bank also launched a liquidity bill auction with a 91-day maturity, its first such issuance in nearly 2 decades, aimed at absorbing excess cash from the market. Meanwhile, Turkey's economic policymakers, led by Turkey's Treasury and Finance Minister, are considering further measures to support the lira, including lowering taxes on lira deposits to encourage local currency savings. Wolfango Piccoli, co-president at advisory group Teneo, wrote in a note on Monday, quote, "The protests mark the first significant and widespread public reaction in over a decade, making the trajectory of events difficult to predict. What is evident, even at this early stage, is that political uncertainty is far from over." End quote. Adding, quote, "Once again, President Erdogan's political agenda has inflicted serious damage on Turkey's economic outlook." End quote. While Turkey's government is taking aggressive steps to contain market turmoil, analysts caution that without a resolution to the political crisis, financial instability will likely persist. Anti-government protests continue across the country, with authorities detaining over 1,000 demonstrators since the 19th of March. The uncertainty surrounding the arrest, which could bar the opposition figure from running against the president in future elections, adds another layer of risk to Turkey's fragile economy. Hey everyone, if you would like to be on top of the most consequential and up-to-date financial and economic analysis from around the world, maybe consider subscribing, hit the bell notification icon, and you will be. And if you're getting some value from today's episode of Market Update, it's a big help too if you can just hit that like button. Thank you so much. And finally for today, we move to Asia. Malaysia's economy is projected to grow between 4.5 and 5.5% in 2025, building on a 5.1% expansion in 2024, according to the latest report published this week by Malaysia's central bank. Despite global uncertainties, including rising protectionism and geopolitical tensions, the governor of the central bank remains cautiously optimistic, citing robust investment activity, positive labour market conditions, and income-boosting policies as key drivers of domestic growth. Malaysia's economy accelerated from 3.6% in 2023 to 5.1% in 2024, supported by stronger household spending and an export recovery. This year, the central bank expects continued momentum, with the services sector projected to grow by 5.6% and the construction sector by 11%. International tourism arrivals are also set to rise. However, inflation is expected to climb to between 2 to 3.5% due to the government's rollback of fuel subsidies and increased sales tax rates. The central bank has maintained its benchmark interest rate at 3% since May 2023, ensuring monetary stability while navigating global economic headwinds. Malaysia's strong export recovery in 2024, particularly in semiconductors, reversed an 8% decline in 2023, with total exports growing by 5.7%. The country's neutral foreign policy and strategic position within the global supply chain has made it a preferred destination for companies seeking to mitigate risks from US-China trade tensions. Local economist Doris Liu noted that Malaysia's growth outperformed several regional economies, including Singapore 4.4% and Indonesia 5.03%. Leveraging its ASEAN chairmanship in 2025, Malaysia is poised to further integrate into global supply chains, enhancing its trade resilience. Malaysia's semiconductor sector, a cornerstone of its manufacturing economy, is facing a few challenges, however. Malaysia is tightening semiconductor regulations amid US pressure to curb illicit chip flows to China. Malaysia's trade minister, speaking to media this week, said Washington demands strict tracking of NVIDIA chips due to concerns over export rule violations. A task force has been formed to regulate Malaysia's growing data center sector. The US recently expanded chip export controls too, fearing AI chips with military applications could reach China, and indeed already have. Singapore has also charged 3 men in a $390 million fraud case linked to Nvidia chips. Malaysia denies evidence of improper transfers but acknowledges enforcement challenges in the complex global supply chain. Meanwhile, the reintroduction of US tariffs, particularly up to 25% on semiconductors, threatens Malaysian firms with heavy exposure to Chinese markets. This uncertainty has led to a sell-off of key Malaysian technology stocks. And on top of this, China's DeepSeek's success in achieving AI advancements with lower-cost chips has raised concerns about reduced demand for high-end semiconductor components. Despite all these disruptions, Malaysia is positioning itself as a key player in the evolving semiconductor landscape. The government recently announced a strategic partnership with ARM Holdings to bolster local integrated circuit IC design capabilities. Investment Minister Aziz emphasized that Malaysia's push towards front-end semiconductor production aligns with its goal of capturing higher value segments of the supply chain. Malaysia's so-called Silicon Valley of the East in Penang remains a semiconductor hub, but capacity constraints, including land scarcity and energy demands, pose challenges. To sustain growth, the state government is investing in infrastructure to enhance its appeal to multinational technology firms. As Malaysia navigates a challenging global economic landscape, its ability to capitalize on trade shifts and technological advancements will be crucial. By strengthening strategic partnerships, investing in semiconductor capabilities, and leveraging its geopolitical neutrality, Malaysia stands to maintain its economic resilience in 2025 and beyond. Okay, that is today's episode of China Update. Thank you so much, Market Update. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you all tomorrow.